Let's start with what a prop firm actually is. So prop trading, short for proprietary trading, means you're trading with the firm's money, not your own. So you pass all of their challenges and prove you can manage your risk, and they'll give you a funded account. It sounds simple. It usually works in two stages. You hit the profit target without breaking any drawdown rules, and you good. Stay consistent long enough to prove that it wasn't just luck, and you good. In return, they take a cut. That's usually about 10 to 20%, and you keep the rest. Now, this sounds simple until the rules start to matter. Now, there are some pros and cons to trading with the prop firm. We'll get started with the good. First, there's access to capital. Prop firms give you a chance to trade six-figure accounts with just a few $100. That's huge. Most new traders never have the funds to size up responsibly, and prop firms can help bridge that gap. Second is structured risk management. Those strict rules, yes, they're annoying, but they force discipline, daily loss limits, consistency rules. They teach you what it means to protect your capital first. Third is the performance-based rewards. Prop firms don't care who you are. If you follow the rules and you make money consistently, you can scale. That's rare. In trading, you're judged purely on your execution. Four is it's a psychology training ground. Trading with someone else's money sounds easier until you realize that your ego is still on the line and you can't detach your emotions from your performance. And that's priceless. Five is it's a low cost of entry. You can start with a few $100 instead of using like $10,000 of your own money. For some people, that's the only way to get started in trading, and that is completely fine. Now let's get into the part that most people ignore, the cons. First is hidden rules. Some firms change the game up mid-play. You might hit your target and still fail because of a technical violation. So news trading restrictions, daily limits, or weekend positions. So always read that fine print. Second is payout delays or flat out denials. Not every firm plays fair. There are a lot of legit ones and there are a lot of not so legit firms. So payouts can be not paid for vague violations. So treat it like a business relationship and vet the partner you're working with. Third is you have no real ownership. At the end of the day, it isn't your account. You're renting access to the account. The moment you break a rule, the capital will disappear and that illusion of success will go with it. Fourth is the psychological pressure. Prop firms create a pass or fail type of mindset. You start trading to avoid failure instead of actually trading your plan. That pressure can break good traders. Fifth is sustainability. Passing a challenge once, that isn't hard, but maintaining consistency for months, that's the real test, and that can break even seasoned traders. Now, let's get into prop firms versus you trading independently. So, prop firms are a shortcut to experience. You get structured rules and funding fast, but independent trading gives you freedom. So you get freedom to control your own risks, your capital, and your strategy. If you're serious about building longevity, prop firms should be your training ground, not the end goal for you. Use them to refine your discipline, not replace your process. So in closing, prop firms aren't really good or bad. I consider them a tool. And like any tool, it only works if the person using it has skill, patience, and a process. Now, if you guys picked up or learned anything from this video, consider hitting that follow, like, and subscribe button. It helps get the information out to other traders just like you, and we can all help each other build a community and build wealth together. Peace.